What's up? Today we'll be taking a look at leveraged ETFs. We'll discuss what they are, how they work, the risks of using leveraged ETFs, how they should be used, and how they shouldn't be used. This video can potentially save investors from some serious hurt. We'll also take a specific look at some of the most popular leveraged ETFs. At the end, I'll give my own opinion. If at any point you decide you like this video, feel free to hit the like button because that's what it's there for. Also, feel free to lurk below and check out the links in the description. You can get free stocks, free crypto, and other fun stuff. Without further ado, let's get started. A leveraged ETF is a marketable security that uses financial derivatives and debt to amplify the returns of an underlying index. So while a typical ETF tracks its index on a one-to-one basis, a leveraged ETF may aim for 2x or 3x the returns of the index. This can greatly amplify both gains and losses. Leveraging is an investing strategy that uses borrowed funds to buy options and futures to increase the impact of price movements. Options contracts give an investor the ability to trade an underlying asset without the obligation that they must buy or sell the security. Options have fees associated with them, called premiums. Leveraged ETFs tend to have higher fees than non-leveraged ETFs because of these premiums that need to be paid to buy the options contract, as well as the cost of borrowing, aka the cost of using margin where you have to pay interest on borrowed money. Let's say, for an example, an ETF returns 10% in a month. One would expect a 3x ETF that tracks the same index to return 30% during that same month. However, this is not necessarily true. One reason being the higher expense ratio that comes with the leveraged ETF. But this isn't the most important thing to note. The most important thing to note is that leveraged ETFs have to rebalance daily in order to achieve appropriate levels of assets to provide their implied leverage. In other words, a leveraged ETF is essentially marked to market every night. It starts with a clean slate the next day, almost as if the previous day had not existed. Over time, the compounding of this reset can potentially vary the performance of the fund versus its underlying benchmark. Compounding being the cumulative effect of applying gains and losses to a principal amount of capital over time. Usually volatility is a trader's friend, but in the case of leveraged ETFs, volatility and negative compounding mean that investors in leveraged funds will lose money over time, unless they trade in and out at just the right time. This concept is easier to understand with real-world examples, so let's illustrate this concept with 3 different charts. In the first chart, we have a 2x ETF with an index that goes up 10% for 10 days. At the end of the 10 days, you will notice that the amount of the 2x ETF is notably higher than 2x the 10-day index value. 2 times 259.37 equals 518.74, and yet we have 609.17. Good, this is a huge win. However, the opposite is true in the second chart. Here we have a 2x ETF with an index that goes down 10% a day for 10 days. At the end of the 10 days, you'll notice the amount in the 2x ETF is notably lower than half the 10-day index value. 34.87 divided by 2 equals 1743, and yet we have 1074. In the third chart, we have a 2x ETF with an index that oscillates between 10% up and 10% down each day. This kind of volatility exasperates the leveraged ETF drag. At the end of the 10 days, the index is at 95.10 and the 2x ETF is at 81.54. These examples show how leveraged ETFs can skew long-term results. If your timing is right, this can be good. If it isn't, it can be devastating. So leveraged ETFs are typically used by short-term traders who want to speculate on an index or to take advantage of short-term momentum. Because of the high-risk, high-cost structure of leveraged ETFs, they are typically not used as long-term investments. After all, the derivatives that create the leverage in these ETFs are not long-term investments. Typically, traders that use these leveraged ETFs are only using them for a few days at the most. So let's take a look at some of the most popular leveraged ETFs. Here I have them sorted by net assets. The most popular is TQQQ. This ETF aims to provide 3x the daily return of the NASDAQ 100 index. This is a very large and liquid ETF, making it a favorite for traders. You can see why this would catch the eye of a beginner investor. When you look at it on Robinhood, it shows a 1,200% return over 5 years. It's definitely a good thing that they have a warning on the page so that newer investors have a heads up on what they're getting into. Moving down the line, we have QLD, which is 2x the NASDAQ 100. SSO aims to provide 2x the daily return of the S&P 500, while SPXL and UPRO aim to provide 3x. Going further, we have sector-specific leverage ETFs for traders who are looking to time sector rotations. Most of the time when people try to time sector rotations, they're one step behind and end up getting suboptimal returns. So chasing returns can be dangerous. But we also have SOXL, which is 3x for semiconductors, FAS for 3x financials, and TECL for 3x technology. We also have leverage inverse ETFs. In other words, traders buy these when they expect the index to go down in value. If you didn't know what an inverse ETF was and how it was supposed to be used, and you saw this graph, you would think it was the literal worst investment of all time. Buying an inverse ETF is usually cheaper than short selling, and you don't need a margin account. You need a margin account to short sell because you're essentially selling something that you don't own. Therefore, with the leverage ETFs, you don't have the risk of being margin called. A margin call is when a broker asks for more money to shore up the account if the collateral securities lose value. If the investor is unable to bring their investment up to the minimum requirements, the broker has the right to sell off the positions and also charge any commissions, fees, and interest to the account holder, many times forcing you to sell at the worst possible time. The classic buy high, sell low motto of Wall Street bets. Also, sometimes investors will use these inverse ETFs to hedge their portfolio in the short term. Getting back to leverage ETFs in general, like we said before, fees are high. All these leverage ETFs are hovering in the 0.9 to 1% expense ratio range. So if leverage ETFs aren't for long-term investors and are more designed for short-term trading, it begs the question, should I become a day trader in order to get on some of these juicy leverage gains? Well, the statistics on day trading are pretty grim. We have all heard that stats saying 80% of day traders lose money, 10% break even, and only 10% consistently make money. Being a successful day trader requires a thorough understanding of how markets work, a thorough understanding of technical analysis, and it requires a disciplined trading strategy. And it requires at least 3 computer monitors. So it's hardly a part-time gig. Short-term movements in the market can be volatile and seemingly random. Additionally, you are going up against high-frequency trading algorithms that can automatically execute a large amount of transactions in just a fraction of a second. If you do manage to turn a profit, you will always be paying the higher short-term capital gains tax, which is taxes ordinary income as opposed to the more favorable long-term capital gains rate that long-term investors pay when they hold for more than a year. Also, 80% of traders quit within 2 years. So I don't mean to be Debbie Downer here, particularly for those that are willing to put in the work to be successful, but I don't think most beginner day traders know what they're getting into. Most people should avoid it entirely. But if someone is willing to put in the work to be successful at day trading, I would certainly applaud them for that. But conventional wisdom tells us that the more diversified you are and the longer your investing time horizon is, the better chance you have at making money. The market can be a casino in the short term and a reliable generator of wealth in the long term. So what is my opinion? I've pretty much already given my opinion. For the most part, I try to avoid short-term investing and trading, and therefore I avoid short-term trading instruments such as these leverage ETFs. As a beginner, there were a few times where I played with these leverage ETFs with a small amount of money. I ended up getting nothing done at work because I was just sitting there watching my investment go up and down by a few percent all day. I never made any money doing it, so not the best use of my time. I really didn't have the time or the desire to put in the work to be successful at day trading. So this video isn't supposed to be a hit piece on leverage ETFs. I think they're a fine short-term trading instrument for those that properly know how to use them. But as for me, anytime I buy a stock or an ETF, I ask myself, am I comfortable holding this investment for 5 years? Also, if the price were to drop 15% tomorrow for no valid reason, would I regret my decision and panic sell, or would I take the opportunity to buy the dip and hold it for the long term? If I can't give the right answers to these questions, maybe I'm better off just not buying at all. In fact, I try to not buy individual stocks at all unless I feel very strongly about the trajectory of the business. I found that I tend to do much better with my highest conviction holdings because of how willing I am to buy the dip when there's blood in the market. But that's just my 2 cents. But if you found any of this helpful, consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently, down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, a free stock with Robinhood, potentially valued up to $225, and up to $250 with BlockFi, where you can earn interest on your crypto. However, these promos do change over time. As always, none of this is considered financial advice. It's for entertainment purposes only. Thanks, and I'll see you in the next video.